Perfect. I think we're set.
Yep.
Great. All right. So hello, everybody. Thank you for coming. My name is Morris. I'm here with Eddie. We're pretty much, we're going to talk about investing strategies and just pretty much give an idea of what some of our beginning strategies were when we started investing. Like a little bit about myself. Of course, I grew up in El Salvador without any knowledge, of course, of how to deal in the stock market and the economy in the United States. And, you come here and you start grinding as much as you can. You do whatever you can in order to survive. I started painting houses. I started cleaning houses back when I was in high school. Then, I decided to go to college, got out of that, graduated with a master's, and now working at IBM as a computer engineer. But I found in the last few years, it was necessary for me to start making that money that I was making through my job, be able to grow without me having to put any effort to it. And what better way to do it than the stock market? And, that's pretty much what I did. Actually, I started with crypto in the beginning. And maybe that was the mistake I did. I shouldn't have started with crypto. But that was a little bit of a crazy world. Yeah, crazy world up in there. But I stuck with all the crypto before the crash of 2017. I kept all the crypto, and now Jesus Christ, thank God I did, because now it's more than triple, quadruple its value, so it's good. But yeah, that's pretty much me. Eddie, want to share your introduction?
Yeah. So for myself, I grew up in Long Beach. And I got started investing in 2017 during the crypto phase, right, when it was popping off. I first learned about it through Morris, right? Because I remember we were playing some video games and everyone was talking about it, and then Morris was talking about it. I'm like, oh yeah, it's crazy right now. So and then I talked to Morris a little bit, and then I jumped in. And then that same year, I think Snapchat, they IPO'd. So and then I jumped into that as well, and that's how I got started with investing. But I took a pretty big loss with the cryptos, because once it tanked, right, once it dropped, I think in 2018, right, I sold everything. I lost probably like 3,000, 4,000, but I put it on my taxes, right? And that's one thing that I learned from that, is not to really follow the trends as much, right? To really do my research, like, okay, what am I getting myself into, right? Because I was just like, hey, everyone's making money. Okay, I'm just gonna throw money in there, and then try to get rich overnight or whatever. Because people were like, oh yeah, I made like 10,000, I made this much, and whatever. So that was a big lesson that I learned from there. Is to do your research, right? Risk a lot of times comes from not knowing what you're putting your money into. But that's how I got started investing. And then, as I started learning more and more, you start finding strategies, right? What works for you. There's a bunch of different methods, but we'll get into that later on. And then one thing about me too is I met Morris in college, right? I was a business major with an emphasis in accounting. And one thing that always stood out to me was that, they never taught us how to invest our money, right? And that's why I'm such a big advocate on, what to do with your money. If you follow me on social media, I'm always preaching about investing into assets and things like that. And if you don't know what an asset is, it's basically anything that puts money into your pocket, right? And that's an accounting term. And accounting is basically like the backbone, the foundation of any business, right? You got to be able to understand the numbers. If you can't understand the numbers, then you can't really understand the business, right? To see how it's doing. But yeah, that's a little bit about myself and how I got started in investing.
Yeah, no, we pretty much met in school. Yeah, Jason. So I saw your question. But yeah, we met in school. We actually didn't met through class. We met through an organization, a fraternity, Single-Ended Data. That's pretty much where we met. And we've known each other since those days.
Yeah, I met Morris when I was 18. Yeah,
Yeah,
so
no, at that time I think I was 22, 23, I think at that
yeah,
time. Um, but yeah, so I mean, it's definitely, it's been a long time since since those days of college, and now we're both, yeah, so young. Yeah, now we're both
yeah,
doing our own thing. We got our careers. We're pretty much just going through well, at the same time, we have our jobs, but we're also trying to start like a second stream of income, or second, like a side hustle, a job, a secondary, something that is actually we are the owners of. So he's starting his own brand. Like, he has his own watch company. He has his own yeah. So that's his watch, by the way. If you guys want to check them out, he has it in his link. And pretty much, yeah, we're both trying to start our if one way I can put it is when we don't have to work anymore, where our jobs are not longer, owned by someone else. We own our own time, we own our own income, and it comes from stuff that we love to do. Not what we do, which is, I mean, I love engineering, but we want to do something that it's. And another thing that I like is talking to people. So for me,
yeah,
this talking to you guys on a weekly basis, it's not an issue for me. I can do this every day. I do this every day with my friends, actually.
yeah,
Yeah, we're trying to get our kids to be riding those Lambos. So
yeah,
make sure that what we give, and this is also something that Eddie and we both agree on, is having that generational wealth for our families.
yeah. And then I
But yeah,
think
definitely.
to piggyback off what you said, more, so like if we look at both of our career paths, right? Like I went into business, accounting, more like the financial field. Morris went into engineering, right? Just because I went into business doesn't mean like, oh, I should know about investing and all this other stuff, right? And if you look at Morris, right, he's an engineer, right? And with him, it's like, oh shoot, you wouldn't expect, him to know all about investing and stuff. And it just goes to show like all this is a lot of it's self-taught, right? You gotta um, take time to really talk to people, to really go out there and do your own research, right? There's a reason I feel why this stuff isn't taught in school. And in my opinion, the reason that is because, uh, you know, with the purpose of school, if they were to teach everyone how to like, really make money and do all this stuff, it would be hard just for like everyone to get to really build wealth, right? Because there's only I mean there's an abundance of money, right? They're printing it, but like the goal a lot of times is like, oh, the American dream, right? You want to go to school, get a job, get a 401k, have a house, and then that's it, right? So that's kind of like the school system is, I feel, designed for. It's not really taught. It's not really designed for us to really build wealth and have multiple streams of income.
Yeah, no, it's definitely something that we had to learn on our own. It wasn't taught to us, not even from middle school, high school, nothing like that. And it's something you have to learn. It's a process, having to learn all of those things. But trust me, once you do it, it's rewarding. And why, you may ask, that we're talking about why you should learn this, is pretty much the reason why we're meeting today, and having that kind of investing mentality even when you're younger, because we want to make sure that you, as you grow older, you're able to make your own decisions on how to invest your money. You learn from like the stuff that we know, the stuff that we made the mistakes in, and that way you can make your own decisions on where to invest. And at least for like one thing that Eddie and I, are pretty much like agreed on, is like, as an investor, if you're new and you want to get into investing, you should go into a long-term strategy. And why? And that is because that's where you have less risk of losing most of your money. When we started, we started with like a very high risk, high reward kind of strategy. Crypto was not
Yeah,
really, not even what it is now. It was more like volatile than it is now. You saw price jumps of thousands every single week, and also price decays of thousands every single week. Now we're seeing more of a tapering off of those kind of losses, where you see maybe like a loss of a few thousand every week, and then it's sporadically, it spreads longer. And that's what we want to pretty much talk about. You know, the way you should put your money should be for a long-term strategy first before you jump on these other more volatile, more scary, you know, type of scenarios. So yeah, Eddie, what's your what's your opinion on long-term investing? I know you're a big dividend investor, and that's
Yeah.
your form of investing.
Yeah. My strategy when I invest is, I'm looking to hold for as long as I can, right? If unless something dramatic happens, right? So when I look at companies to invest in, right, I look at how long the company has been around, what products do they sell, do I use any of their products, um, and if they pay out a dividend, right? With me, my goal is to build up a portfolio to where it's paying me um, a decent amount each month, right? So like right now, I get 100 minimum each month in dividends, right? So that's like 1,200 roughly. But that grows over time because those dividends that I get, I reinvest it. And dividends are basically a cash payment from the profit that the company has. But long-term investing, I think, is key because you never know what's going to happen, right? Like, for example, I like the whole GameStop and AMC thing, right? I was an investor in AMC since I want to say like 2018, right? I got into AMC. They paid out a decent dividend. Um, and they were just starting their subscription membership, right? Where like I think it's called like AMC A List or something. Like, oh, you could watch an unlimited amount of movies or something each month, all the new releases, and you just pay like a certain fee. But once the pandemic hit, right, and everything was closing down, uh, you know, that's when I sold because I was like, man, I don't think they're going to everything's going to go back to how it was, right? Just with like Netflix, Disney Plus, and all these other platforms coming. But next thing you know, everyone was buying AMC stock, right? And it was going up like crazy, right? And it's
It's
going to show
crazy.
you like, hey, sometimes it's good to just buy and hold, right? That's where you're really going to see a lot of the gains in your portfolio is by holding, right? Because on average, the stock market typically returns like 10%, right, over the years. I think since like 1970, it's returned about 10% off the top of my head. But to keep your strategy, I think, simple when you're first starting off, you should look at each company that you purchase um, to at least hold. I would say at least for 5 years, right? Hold it for 5 years. Let it do its thing and let it grow, right? Like I think a great example of companies, right, to really see like how well they perform is you could look at Apple, you could look at Microsoft, you could look at Google, Facebook, right? Look at how long, look at the history of those companies, right? From like 5 years, 10 years. So um, that'll show you the benefit of holding for the long run, right? Rather than just trying to buy a stock and flip it, especially when you're first getting started.
Yeah, yeah, it's definitely oops. Let me go back. Oh, yeah, oops.
You gonna share your screen?
It's definitely, yeah, I was gonna start sharing the screen, but it's definitely a riskier approach when you're not holding a stock that you believe in. If you're just doing it because you know people are telling you to buy it, you're definitely gonna have a hard time trying to justify why you're holding it, especially when you see the ups and downs. And there's gonna be ups and downs in the stock market anytime. There's always been ups and downs, but at the end of the day, the stock market has always come out on top. It has recovered. There's been recessions throughout history, from even the beginning of the stock market, back when it started in the beginning of the 1900s. There's been ups and downs, wars. We've had nuclear standoffs. We've had famines, and in every single scenario, every single event, the stock market has recovered from any kind of recession or crash that it pretty much had to go through. And at this point, it has just become a cycle. And it's just how the economy just at this, yeah, it's just the behavior of the economy. And all the economists, they know that pretty much follow the stock market. They know this, and they know this is the trend of the stock market. And you see big investors like Warren Buffett warn people, if you're not someone that can stomach 5-10% crash of your stocks, you shouldn't be owning stocks, because you shouldn't be making decisions just because the stock crashes 5-10% or because the stock goes up 5-10%. You should be making decisions on investing 5-10 years ahead. So you know that you're gonna buy a company that is a good company. You're gonna hold it at least for a year to avoid to avoid having to pay big taxes in case you're selling it for a profit, and to make sure that you're holding a stock that is only going up. So make sure you also make good decisions in investing. But yeah, Eddie, if you can you share me the ownership? That way I can share the screen. My bad, I
Yeah,
forgot to tell you.
I got you.
Thank you, thank you. Ah, great. Let me see. I'm
You
gonna
got it?
share this. Yep, I see it now. Let me see how this looks. Oh, this one's different. Yeah. Share screen.
But yeah, I think like what you're saying, it's definitely good to hold long term. And like what Warren Buffett likes to say, I know his one of his philosophies is like, hey, if the stock market were to close forever, would you be okay holding that company's stock, right? And that really gets you thinking like, hey, should I buy this um, or should I not, right? And that should keep you in the game too if the market were to go down.
Mm-hmm. Yep. And this is the main thing, what we want to talk to you guys about when it comes to long-term investing. You have two separate securities, and this is one thing that I would say, you should guys like look into. And Eddie and I, we both like to invest in this mix of securities. You have the stock, which is, a part of a company. They pretty much say, okay, we're gonna set this many stocks once the company goes public. And when you buy one stock, you're buying a piece of that company. But then we have an ETF, which is like an exchange traded fund, which is a mix of a bunch of little companies that, well, it's a mix of all companies, but just a small amount, not even a whole stock of a company. It's just a very, very small amount that you're investing in when you buy one share of this exchange traded fund. And Warren Buffett, one of his biggest things is, if you are somebody who does not have the time or the ability to look at your stock portfolio on a weekly or maybe at least bi-monthly basis, you should do a passive approach to investing. And one of the best ETFs you can buy for a passive investing is the S&P 500 ETFs. And there's a bunch of those. Some of our favorites, we have VOO, SPY, but at the same time, you should do your own research when it comes to these. And like I've mentioned in past classes or meetups that we've had, is that you should look into if the etf.com to do your own research on these ETFs. And I know Eddie has some that he loves to invest in, which very much pay you dividends as well. So you can do this approach, which to me it is for somebody who's new and who doesn't know if a stock is going to go up or down, or you're not sure what's going to happen in the market in the coming months, or you don't even care to worry about what's going to happen in the market in the coming months. An ETF is the easiest approach, in my opinion. If you ever do ETF, if you ever do investing as a beginner, this should be your number one priority. Make sure you are diversified and make sure you're risk adverse in the beginning. That way you have a faster and of course a better experience when it comes to investing. You want to make sure that if you're a beginning investor, you're not investing for the loss. You're investing to make some money, or at least maintain the same money that you invested in for a while. And yeah, do you have any other comments about stocks and ETFs?
I think ETFs are great, right? Because like Morris said, it makes investing a lot more simpler, right? I think when you're first getting your feet wet and you're really learning to analyze a company's, financials and really dive into how profitable they are and things like that. ETFs simplify that, right? Because what you do is, for example, you put $1 into the uh, S&P 500, right? And what they do is they take that dollar and they'll take a portion of it and put it in different companies. So the S&P 500 is basically the top 500 largest companies in the US, right? So like Apple, Amazon, Microsoft. I want to say, I think Tesla's in there, Home Depot, McDonald's, right? So for every dollar that you invest, they're going to take a portion of that and put it to all these companies. And I think that's beautiful, right? You don't have to try to time the market. You don't have to pick and choose like, hey, I'm going to buy now. Oh, should I wait? Is the market going to crash? I think if you're consistent, right, just constantly putting money into that ETF, you'll see a lot of gains over the long term, right? Because a lot of the greatest companies in the world are US based, right? So I think it's definitely an easy way to keep your investing simple, keep it consistent, and takes out a lot of stress in reading and trying to dive into companies and then make a decision if it's even worth it, right?
Yep, no, definitely. I really agree with that. It's, in my opinion, it's the easiest form of investing for anyone that's looking into investing. And it's one that I really, I don't know why it shows this little arrow here. I'm trying to get rid of it. But definitely is the easiest form of investing for anyone that's really new and wants to get into investing. Um, and as you can see, you have a company, of course, when you buy a stock of one company, there's a chance that it's going to be a fast growth company, and there's a chance you're going to have fast depreciation as well. So you have this flip of a coin when it comes to investing in a company. So you have this issue right here. But when you're investing in an ETF, you have a slower growth, a slower depreciation. So you see, if for some reason the stock market crashes, you're gonna see a very slow depreciation of your money compared to what you do if you have a stock. You're gonna have a faster depreciation of the money. So in case, let's talk about if Apple for some reason falls 10%, your money that you put in the Apple stock will fall 10%. But if you put in an ETF, and let's say this right here, this little pie or slice of pie right here is Apple, only this slice of pie will decrease by 10%. But everything else in the pie will remain unchanged. So you don't lose 10%. You lose maybe, if this is a pie of how many? 8, you maybe lose 2% compared to losing 10% of a whole company. You lose only 2% of an ETF. And that's the beauty of ETFs. And you pretty much, the risk that you are exposed to is smaller. So, and this is one of the biggest things. Like, I want to write that, but it's not letting me. Risks are smaller when you invest in ETF. Another thing, and this is one thing that Eddie, we're in, and both of us, we pretty much are into, is dividends. You can invest in one company that pays you dividend, or you can invest in an ETF that pays you dividends. And when you invest in an ETF, the dividend, if for some reason, the company decides to stop paying dividends, this one company and this one stock will stop from paying you dividends. But if the same thing happens here, if one company decides to stop paying dividends, only one company is affected. The other companies are still going to be paying you dividends, and an ETF will still give you dividends, no matter if the company stops paying dividends. So it's going to be offset by the other company's dividends. So that's another thing. You get protection from your dividends. There's a bigger chance, for one company to lose dividends than it is for an ETF to lose dividends. You may see a decrease in an ETF, but you'll never see a loss. compared to a company can decide to stop paying dividends like this, and it's over. You stop getting dividends. But you also get more dividends when it comes to companies. You know, there are companies that are paying you almost 10% of a dividends. Actually, there's companies that are paying you more. And you know, there's ETFs that can barely get to 2, 3%, but it's because you have a bigger pie of companies that they have to manage. So, and they take a cut. Of course, there's a expense ratio. So, that's another big difference that I want to talk about in the talk. And already you want to talk about expense ratios and what they are and stuff?
Yeah, basically the expense ratio is kind of like a fee for investing into that ETF, uh, that they take a portion of the profits, right? So, like for example, on the dividends, the the expense ratio, they take a portion of it for themselves, right, in order to keep the fund running and everything, right? Because there's a little bit of management fees and everything like that to keep it going, right? And some ETFs, if there's like a new, like when Tesla went into the S&P 500, right? A lot of these management companies of the ETFs, they have to go and like, okay, let's reallocate the funds, right? We got to take this stock out and now we got to put in Tesla. A good rule of thumb for expense ratios, in my opinion, is to be under like 0.5 of a percent, right? Not 1%, but 0.5 of a percent, because over time, um, those expense ratios will add up, right? And I think a lot of the expense ratios come into play when you have like a 401k or a Roth IRA or anything like that, right? An employer contribution plan. You want to make sure you look at the expense ratios, right? Because sometimes on some of the funds that they give you where you could put your money in, the expense ratios may be high, right? And that might be eating a lot of your gains, and that could be a reason why your portfolio isn't growing as much either. So look out for the expense ratios. It's basically just a cut that the fund takes.
Yep, and it's pretty much you want to make sure you have as low, I mean, at the lowest expense ratios as possible, in order to maximize your profit. That's another thing. The higher the expense ratio, the less money you'll make out of the ETF. But let me go back and reshare this, because now I think I got rid of the issue of the arrow that was giving me. Perfect. Okay, let me go back and share that on Zoom. There we go. So we already talked about ETFs, and we're going to talk about what the difference between a stock and an ETF. Of course, those pretty much are the main things. You know, you have exposure to different companies, diversification, you have lower risk, as well as having the ability to invest in many companies at the same time and get dividends from them. And also, you know, you get oops, the screen share is paused. Let me fix it again. There we go. Okay, so I guess now it's good. No, it's still paused. Let me see. Oh, where did it show? Where am I now? I got lost in this thing. Where is Zoom? Oh, sorry. Oh, okay. I see what happened. So I put the Zoom at the wrong place. By the way, anyone has any questions about stocks and ETFs? Everybody good so far? Okay, in that case, yeah, let me share it again. So which are ETFs and pretty much like when it comes to like what kind of ETFs we recommend? Let me put it here. So what is one that you recommend a lot, Eddie, when it comes to investing?
One that I've that I've always preached about and always told people is a SPHD. That one is basically in a monthly dividend ETF. It basically takes the top 50 companies in the S&P 500 with the highest dividend yield. And the reason why I always preach about this one is because, again, you get paid each month, right? You just put your money into it and you get an instant return on it, right? So, like, just to keep the number super simple, let's say you were to put $10 into an investment and you get $1 back, right? That's already a 10% return instantly because you're already getting $1. And then that dollar doubles, right? So the next year you'll have $11, right? And then boom, you get a bigger return on that, and so on and so forth, right? Your money compounds, and those dividends that you get allow you to purchase even more. And that's the beauty of getting started early and with ETFs, right? Because it keeps it simple, right? You don't have to constantly be looking for the next big stock that's gonna pop off or the next big AMC or GameStop, right? You just keep it consistent, put in these ETFs. The money that you make, just keep putting it back and buying more.
True. Yeah. And I know there are some other, I love SPHD as a monthly dividend. There's other ones, but the main one and one that I really will say recommended by lots of people, and we have, a big investing portfolio. They have some of the biggest companies under management. And, it's Vanguard as a company, but their ETF is VOO. Oops, let me write that down.
Yep.
This is one that even every single economist that I've mentioned, I've talked, I pretty much like have read books from or have pretty much read their recommendations for. Even Warren Buffett, he says VOO, just put your money there, you'll be fine. Another one that many people recommend is SPY. These are, they're not big dividend investing. These are mostly, they have a dividend, but their dividend
Yeah.
is not paid monthly and it's pretty small compared to what HPHD gives you, relatively. So these are mostly, they track all 500 companies in the S&P 500. So SPHD tracks the dividend paying companies, while VO puts all the companies that are in the S&P 500. And that's one. These are two of the main ones: the SPY and VOO. Another one, Eddie, that you recommend a lot in.
Another one that I like is I think it's called ARK, ARKK. So this one is basically the tracks a lot of technology stocks, right, based on innovation. So this one's more like a growth type of ETF, right? Since in the technology sector, so like AI, um, computers, and things like that. But VOO and SPY, I think both of those are great foundational ETFs to have in your portfolio. But more, I think ARK, that one's good for future proof, right? Especially since we're evolving to everything being connected to the internet, right? Everything's connected, everything's integrated, right? Like your smartphone has everything, there's lights, smart lights, Siri, Alexa, there's a bunch of stuff. So innovation is key in order for us to grow. Even like cryptos, right? That's technology as well. That's innovative as well. So you can't go wrong with investing in the tech industry.
Yeah, I agree. Definitely tech. It's a fast growth sector in all the economy. There's another there's another tech ETF that, that a lot of people like agree and I've invested on, of course, all the ARK. Innovation ones are good, but there's also, of course, the QQQ. This one tracks the top 100 companies in the NASDAQ. So NASDAQ, just like the S&P 500, is another index, but the NASDAQ, compared to the NYSE, which is the New York Stock Exchange, NASDAQ is another form of exchange, but this one, it's all online. It was created in the 80s, of course, in the whole boom of the internet, in order to make it easy for people to invest in stocks for technology companies. So this is one of the major indices, like this one here, the NASDAQ. And the QQQ is the Invesco technology 100 top NASDAQ companies that it tracks. So when you invest in QQQ, you're investing a bunch of tech companies that are in the NASDAQ only. There's also, some financial companies that they invest in, but mostly just um, technology involved. Another one that I really like when it comes to technology, of course, is there's this fast growth, and I would say this one also kind of like ARC has tech innovation in it, but this one is new. It's called Moon, and it got started because of the term moon for we're going to the moon. That's very much what it stands for. And it's like I forgot who's the company that created this ETF, but it tracks all the companies that are dealing with crypto, as well as companies that are dealing in AI, and kind of like what ARC does, but more into the sector of like the unknown and the fast growing companies. So there's actually a bunch of companies in Moon that deal, but this is, I wouldn't say it's not a foundational. This one, I would write it off. I would still have it, be warned. This one, compared to the other ones, this one's with the most warning out of all of these, because this one tracks mostly, the trendy tech companies. You're talking about like companies that are coming out now that are dealing with AI, companies that are dealing with what is it? The technology, kind of banking that is in the technology. I forget what is the term is, but like SoFi, all these, and Robinhood, which are not really banks or investing platforms, but they mostly kind of like applications um, that are dealing with banking sector, but they're just online. You won't find a branch that's dealing with SoFi. You won't find a branch that's dealing with Robinhood somewhere in your city. They're all online based. So this is all online companies, and the biggest warning of it all: online fast growth. So this one I would watch out with. If you're somebody that, we're young. I like to take risks, so I put my stuff in stuff that I know that I'm not gonna take my money out in 5 years, because these are the companies that are gonna be the leaders in 5 years. We're talking about companies that, like, Amazon is already gonna be the leader at this point. Um, Facebook is the leader in data mining. Apple is the leader in technology for mobile devices. You have Google, the cloud technology. They're pretty much in everything that we do is now in the cloud. So all these companies are fast growth. So my biggest investments are in these companies because I know they're meant for the future. So Moon invest in a lot of the new companies. We're not talking about Apple at all. We're talking about companies that are trying to come up with the new technologies that maybe our kids are going to be dealing with. We're talking about like artificial intelligence. We're talking about like virtual world, crypto, online banking, all this stuff that is too new, and that is just, maybe just starting companies that are just like going into the stock market, like new IPOs in technology. They are the ones investing in this. And is there anyone other ETF, Eddie, that you recommend for this, like a diversified portfolio?
I think that's pretty much it. My biggest one is SPHD and VOO. Those are my ones that I have.
Yeah, in my opinion,
Amount
these,
of money.
yeah, these are money safe. Oops.
Yeah, I think VOO
These are money
Y
right here.
for sure.
Yeah. If you want to put your money and have it in a safe location where you know that it's not gonna create so much of a crash in case a crash does happen, these are your foundation. You can also put it on KKK, which is also another foundational one, but it's still, tech. So tech goes up and down fast. But these here are the slow growth, the slow depreciation. You're gonna be fine with your money in these. Now we talked about ETF and which investing. Is there any blue chip companies that you invest in, Eddie, or that you like investing in?
When it, blue chip companies,
Yes.
um, yeah, I mean there's a lot to invest in, right? I think when it comes to looking at individual companies on like, hey, what should I invest in? Start with what's around you, right? Go through your house, look what you have, right? Go look at your shampoo, go look behind it, and look at the at the brand, right? Behind it on the bottom, it typically says who owns, right? It'll say like, hey, Johnson and Johnson, or you know, you buy products at Walmart, right? It could be from them, Target, McDonald's, Coca-Cola, Pepsi, right? Like, I think that the biggest one that I have in my portfolio, as far as a blue chip stock, is Pepsi. Why Pepsi? Is because Frito Lay. Frito Lay is basically, Hot Cheetos, Doritos, like those are everywhere. Especially, there's a party or anything, people are gonna buy those chips, right? You see them everywhere. So I think that's when it comes to blue chip stocks, you want to look at what's around you first, right? Like Neutrogena, I think that's owned by Johnson and Johnson off the top of my head. Same thing with Clean and Clear, right? Like if you use any of those products to clean your face or the lotions, whatever, right? Those products, they've been around for so many years. Those are great companies to invest in. They're not going anywhere, and they're constantly innovating as well. Even I think another one is like your phone service, right? Who are the two biggest companies when it comes to um, internet connection, right, and cellular data? Verizon and AT&T. Those are another two good companies to invest in.
Sure. I mean, pretty much, you want to, when it comes to blue chip, we're talking about companies, and this is a term, why blue chip came into, why people call them blue chip. It started with tech companies first, but it slowly and through many crashes, we figured out the blue chip has become a broad term that encompasses, some of the safest companies in the stock market. These are companies that maybe they pay you a dividend, maybe they not, but if you're investing in them, you're investing in a company that through crashes, it has survived, it has maintained its value, and it's a growing company in a sector where they pretty much are the leaders. So they have a big moat, which is a advantage in the business, or advantage in the business that they're part of. So J&J, PP, VZT, like the ones that Eddie mentioned, they are the leaders in their respective sectors in the mobile world when it comes to healthcare or for products for consumption, like Frito Lay. You have these companies that no matter if you're losing your job, if you're losing your savings, you're gonna buy a Cheeto bag no matter what. If you're losing your savings, you're gonna try to, cut going out instead of cutting out your phone bill. So these are the things that people at this point, depend on. So all these products, all these companies create products that people depend on, and that's why they're crash protected and they're safe companies. When you also blue chip also, since like we talked, technology started with tech companies. At this point, if you invest in some like the top market cap companies for technology, those are also blue chips. So we're talking about Google, talking about Amazon, we're talking about Apple. These are companies that if you put your money in them, not only you'll be protected from crashes, because it's gonna be easier for people to cut out their Disney Plus subscription than it is to like cut out their phone bill. So that's gonna be a given at this point. So if you have an iPhone, you know, you most at this point, if people have an iPhone, like, they're not gonna stop buying Apple products. Once you have one Apple product, it becomes an avalanche. It happened to me. I got an iPhone, then I started getting a Mac and tablet. Now I'm trying to get some other stuff from Apple. At this point, it just has become like a necessity to have an Apple product because of the kind of ecosystem they built. Like once you have one, you want to have the other because it connects to. At this point, I'm using an Apple tablet to write what I'm writing on about. Like this, I can't see, but that's my whiteboard. Yeah, that's my whiteboard at this point, and it's what I'm like. What you're seeing in the screen, that's pretty much the tablet that I'm sharing to the computer. But yeah, just like Eddie mentioned, these are safe companies, and you know that you're gonna be consuming them. Like how many people drink coffee? At this point, I started drinking coffee. I bet you drink a lot of coffee too, Eddie.
Me?
Yeah, yeah, pretty much.
I don't drink coffee. Put it on.
You don't drink coffee.
Also,
But yeah, uh-huh.
oh, I'm sorry. I just wanted to interject really quickly, just because I feel like this is really relevant, especially for the girlies out here who are out here joining us and part of the stalking. Oftentimes, and what that encompasses is also these companies that sell all these products to women, right? Like Estee Lauder, they're a parent company that owns even, let's say you're on a budget, right? You lose your job, rain or shine. I know for me, makeup is a huge thing, right? Cosmetics, hair stuff. They own a lot of even drugstore companies, like I think L'Oreal is under the same parent company as Estee Lauder. So if you look into like investing along those lines, long term that's going to be safe. Or even Elf I know has started to come out with a variety of different products, and I know definitely investing in them. I invested in a couple of stocks during the pandemic when I guess the dip happened,
Yeah.
where it kind of was a small crash, and that really helped me. And I think oftentimes, like, how much do we as women spend money giving into these companies, right? And then but we don't invest in the stock that sometimes it might benefit us a little bit more. So I just wanted to point that out there, because once it started clicking for me, I started investing in these companies. Ulta also has a really, you can invest in Ulta. I think Sephora also has its own stock, but just wanted to throw that out there.
Yeah, no, I did not know this, and Dilly was the one. By the way, Dilly is my girlfriend. She was the one that showed me that there were cosmetic companies in the stock market, and I invested in Elf, because I saw their financials. They were like, wow, this company is making bank, and we like Dilly and I invested in it when it was like $9, right, something like that.
Yeah, it was,
And
I think, even cheaper, like $7 or something. It was some wildly like cheap price during the coronavirus
mhm,
pandemic in the beginning. And then now I think they're almost close to 30. And if you look
yeah,
at long term, they're incorporating the quality is getting better and better. So, and if you look at their history over time, it's only gonna go up. So I highly encourage anybody who hasn't and looked into cosmetic, really look into it, because cosmetics has a history, and it's kind of problematic because it has a history of creating problems for women to buy into, right? Like, oh dang, you have these dark ass circles. You know what? We got you, fam. We got your concealer. Or, oh, you want to cover that pimple? Okay, we got you. They have so many different products, or even stuff that we use on the daily. They're so beneficial to so many different folks. So highly recommend looking into the cosmetics. So it's, I feel like, an untapped little area that a lot of people overlook.
Yeah, that's good insight. Yeah, I was looking at Elf too, and Ulta, but for me, I didn't invest in them because they don't pay dividends. But for sure, I think Elf, right, is a good investment. Same thing with Ulta, right? And I think the biggest thing is, like, again, look at where a lot of people are spending their money. Even yourself, look at where you're spending majority of your time at, right? Like for me, when the whole pandemic went down and everything, right? You saw the lines at Starbucks. Starbucks is still making money. There's people who go every day buying stuff at Starbucks, right? My parents, my girl, you know, they like going to Starbucks. Me, I don't like Starbucks. I just don't like coffee. So me just think now I'm thinking like an investor, right? It's like, oh shoot, let me look at Starbucks, let me do some research. Oh, they pay out a dividend. Okay, I'm gonna get in because again, for me, my strategy is I only invest in companies that pay a dividend. You know, I want cash flow. I want money coming in each month. Uh, you know, eventually to cover my paycheck to replace it, right? Because once I get enough money from dividends to replace my paycheck, now I'm pretty much free, right? I could go do whatever I want. I can invest my time into uh, other streams of income and so on and so forth. So I'm super big on investing in dividends, but yeah, I think definitely the cosmetic industry is huge, right? Especially for uh, you know, just in the whole pride community too. You know, some a lot of people use makeup, and it's huge, right? You know, you have a lot of people promoting it, and I think it hasn't gotten as big as it could be, right? So there's a lot of potential in that whole industry.
Yep. No, I mean, there's so many industries at this point that, you know, that you rely on it. You also saw, especially, you know, with the whole, what we went through this past few years, health became one of the biggest, fastest growing sectors. Why? Because we're going through a one in a lifetime worldwide event. You know, like Mr. Worldwide said, it is a world event. And you pretty much just have to deal with having to have health, one of the pinnacles of our in our economy. And we have companies that are doing great right now. And at this point, we had a new company join the S&P 500. And who was it? Moderna, one of the biggest vaccine makers, that just pretty much just went ballistic with the whole creation of the vaccine, and with the new technology that they're pioneering. They want to bring this mRNA, which is, you know, changing parts of the our DNA in order to fight off diseases, into other type of issues, you know, cancer, leukemia, finding out ways that they can use this technology to affect us in a different way than just, you know, a vaccine. So there's this one, Moderna, of course, mRNA, of course. Who else was also a pioneer in this whole fight against creating the vaccine? Pfizer. So these are blue chip companies, you know, that have joined this like, it's safe company at this point. You cannot lose money if you invest a little bit on these companies. Of course, there's never a guarantee. And, you know, like I've mentioned before, we are not financial professionals. We do not know what's going to happen 5, 10 years from now. We do not know if what we're saying is even going to hold up. I don't even know what's Pfizer ticker symbol at this point. I think it's PFDR. But if you look for as a company, you'll find it for the ticker symbol of the company. But yeah, so like another thing I want to mention, like, we are not financial professionals. We are just here doing this out of educational purpose. You know, it's for you to make your own decisions where to invest your money. We're just giving you kind of like an idea of what we do, so you can either take it or you base your investing style on it. So yeah, we have this, of course. There's one that I really like, which is one of the biggest Warren Buffett health companies, and it's Abby. I've been investing on this one since it was $80, I think. Currently, it's almost at 120, so it's been a good uptick since it started. But it's a health. I think it's ABBA, yeah. A B B A. So this is one. I think it's that. I use spell the ticker symbol. If not, the company's name is this one. At B. But I think that's a ticker symbol. I'm not entirely sure. And of course, Pfizer name is HPV. Pfizer. So, oh, there's a Z at the end. I before getting to the E.
You know what's crazy with all these companies that we're pretty much talking about? Majority of these companies are in the S&P 500, and it goes back to
Mm-hmm.
ETFs that we've been talking about, right? The VO.
Mm-hmm.
Why, if you invest in those, you're basically investing in these companies.
Yep. You're pretty much hedging yourself against any kind of crash if you invest in an ETF that deals with the S&P 500. So just like Eddie said, you're pretty much in good hands. You can do this, which is what most people do that don't know how to invest, or don't have the time to like look at a company's financials or look at their own, investing portfolio on a daily basis. Or you can also look at what the S&P 500 invests in, and you can invest in all these companies simultaneously. You go here, you can go here, you can go here, you can go here. And that's the beauty when it comes to diversifying your portfolio with an S&P 500 ETF. You invest in all these, of course, a small amount, it's a lower growth, but a safer return, a safer, like let's say for some reason, and this, hypothetical because there's no way it could happen. Moderna just doesn't do any good anymore, and just their vaccine just kills people. If this stock crashes, your investment in this company crashes. But if you now that is a part of the S&P 500 ETF, if you buy the S&P 500 ETF and that company crashes, your S&P 500 ETF will still do fine. Maybe it'll lose 1 to 2% of its value, but your total investment in the S&P 500, you're gonna be fine. You're gonna be making still money from all the other companies that are doing well compared to just investing in just one. So that's when it comes to like our first thing, the risk factor. Risk is the biggest issue why you want to invest in an S&P 500 ETF, and why you want to. I'm using if I go fast, it doesn't want to write it. Risk. This lowers your risk, while this increases your risk. But I mean, that's pretty much what we wanted to make sure you guys knew, like the level of risk, what kind of investing style you should do, what kind of value you want to go for. When you invest in all these companies, you want to make sure that you're doing your due diligence, of course. You make your own decisions and you research the companies. But if you don't have time, then at least we can point you in the right direction. Eddie can also give his idea of which stocks that he can give you, which idea of like the investing style you can follow. And yeah, pretty much like, you have us as a resource, and also, your cosmetics companies, I mean, there's all these companies are safe in the S&P 500. Some of them, not all. You're also gonna find out that they're all in part of the S&P 500. Estee Lauder, of course, they're the biggest cosmetic line at this point. They're in the S&P 500. If you want to invest in luxury stuff, LVHM, I don't know if it's part of the S&P 500, but it's Louis Vuitton, Moet Chandon, and everybody's going for luxury at this point.
I think it's a international brand. I don't know from where, but
yeah, I think it's French.
Yeah. It's a French company.
I don't know.
It's like, and like Nintendo, right? Everyone goes crazy over Nintendo, a Japanese company. To invest in as well, but I think the S&P 500 should be part of anyone's portfolio, regardless of your strategy, right? Because that just kind of evens out your gains and everything. That way, you're not waking up one day and you're down like 100% or something.
Mm-hmm. Yeah, no, and it happened to us. Trust us, because it happened to us. And you want to make sure you're well diversified in not only one type of security, not only stocks, but you can, ETFs. If you want and you're, like young and you feel like you want to do it, you can go into crypto as well. It's a growing field that has a lot of potential, but at the same time, a lot of downside when it comes to risk. So it all depends on how risk prone are you when it comes to investing. And like Eddie and I have said, like Or sometimes, we have conversations when we butt heads on our different investing styles, but because that's, he's all about dividends and I'm a mixed kind of style. I like dividends, but I want to do growth a lot more. But everybody, has a different style depending on what they want to do, depending on like what kind of investing risk they want to take. So it all depends on you. Like investing is not one size fits all. There's no one size type of shoe out there. Everybody has their own style. Everybody has their own liking on how much risk they want to take, and you can do that with stocks and ETFs. You can go as risky as possible, or you can go as safe as you can, like investing in a company that like doesn't move much in a year. And you can check by going to like I'll show you guys. Um, Let me see. We're gonna go into um, where you should do some research. Do you have a website that you like doing research on, Eddie?
One that I like to use is Seeking Alpha.
Seeking Alpha. Yeah, no, definitely that one is one of
That's
the
the
best
main one that I
for
use.
it. Let me see, what is my Chrome? There we go, Chrome browser. So like, and I think I've shown everybody this thing too. Like if you go to here, of course, you go to Seeking Alpha, you have one of the best websites to research. And not only just research a stock, but you can research ETFs, you can research dividends, you can research news about the stocks. Of course, some of them are behind the paywall. So if you have that kind of money and you want to pay for the subscription to Seeking Alpha, you can actually do that, and you'll get access to all their news and analysis and like recommendations. But if you just want to just research stocks, of course you go what PEP. If you want to research Pepsi, and you go here, you can look at the historical charts. You can look at the ratings. How well have they been doing in the last year? So if you would put $100, you would have made $16 just 365 days ago. 5 years, and that's the thing. You want to invest in companies that are in a good uptrend. You don't want to invest in a company that maybe this year did well, but the past years it has been doing bad.
Yeah.
So you want to make sure that you're researching as well what is going on, because as we know, the stock currently is not giving you fair value. It's giving you a value that's inflated, but all the money printing and all the monetary policy with all this free money that's flowing around. So a lot of the companies, if you see like what has happened in the last month, there's not really a chart, but yeah, no, in the last year, this company has grown more than it has almost in the past. Let me see, what's a max? Doesn't give you. Well, it started with what, $1, 13, 12. So it started in the early 90s with $12 and is now 116. But if you see, if we go year to date, we have, especially like, I want to say 2 years because it doesn't show you, but yeah, look at this. This is when Corona happened right here. And then of course we have this super fast uptick or just like growth. And this is not even, a company that shows you fast growth. That's Pepsi is, one of the biggest companies with value tied to their name. But if you want to go to like to see some risky fast growth that was propelled by all this fast money and easy monetary policy, you can go to Tesla. And oh my God, it takes a long time to load. Let me see. Let me search for the ticker symbol TSLA. At this point, I've memorized it from just how many stocks I have, and I just keep track of it at this point. Jesus Christ, there we go. Okay, slow down TSLA. And press start. You know what happens whenever I share the screen? This means slow. There we go. So let's go to 5 years, and we'll look right before the start of the pandemic, of course. Let's just take some time for it to load. Oops. Oh man, what happened? I went to headlines. Okay, let me go back one. I know this is an issue with Chrome. It tends to have a bunch of high intensity resources. There we go. 5. And we can go into an advanced chart as well, but we're just gonna look at the trend. There we go. This was Corona right here. And then we saw the stock just like take off. One, because a lot of people were, seeing that the company was actually making profit at this point once Corona hit. And also, a lot of the money that was given out there were people, they couldn't go out, they couldn't do anything. So they put it into investing. So, and, this company was one of the most talked about companies. So what do people do? Put it in some of the most talked about stocks. So slowly we have seen a bleed out from all this fast money. And this is when I started buying at 600. Once I saw this crash, I was like, you know what? This is the time for me to go crazy. So, I mean, I'm still up on some of the investment I did, but if it goes under 600, then I might lose some of that money. But if anything, I'll most likely just claim it as a loss if for some reason at the end of the year hasn't come up, which at this point, they're coming up with their beta, bot 9, they're already releasing their subscription-based autonomous system. They're gonna have the Cybertruck at the end of the year. So I think at this point it's gonna keep going up once it hits 2022. So yeah, just watch out for a good buying opportunity in case it falls down a little bit more. Especially closer to 500, that's a good price for this company. Because people were willing to pay 800 at one point, and yeah, they're gonna reach 1,000 by the end of 2023. And once everything's out and they have another 2 what is it, manufacturing sites that they're building another one in Texas and another one in Germany. Once those are up to full capacity, and they're gonna build one more because they're planning the next one. So once they're making 1 million, right now they're making close to 250,000 cars a year. But once all of the manufacturing is done for these other 2 top of the line assembly lines, they're going to be making close to 1 million cars a year, which is what sometimes Ford makes in 1 year too. So they're going to be competing with the biggest car automakers at this point. So don't sleep on Tesla if I recommend it, but wait for a good price of 500 or lower, and you'll be getting a deal out of this stock. But yeah, so this is what happens during, and most of the stocks that I invest in, they've taken this like parabolic move during Corona. Moderna was like that. What's the name of this other one? MVAX was like that. So all this fast money just propped up the market. So watch out with like a crash coming in the coming weeks. Not even weeks, I would say months, because of people finding out that the stock market has been overvalued, and the money's disappearing, and people need that money, so they're gonna start taking it out from the stocks and putting it into their pockets because they're no longer gonna get it as a stipend. So watch out for that. But yeah, that's pretty much it. Eddie, any closing comments that you have about what's happening in the stock market?
Yeah. Typically, the summer's kind of like pretty chill, right? I think come towards like August, September, you should have some good buying opportunities, I think. But yeah, we'll see what happens. It's always good to have cash on the side just to be ready to make purchases whenever you see an opportunity come. But if you're consistently investing in the S&P 500, it shouldn't matter the price, right? Just keep buying.
Yeah, and just to clarify what Eddie just mentioned, the S&P 500, if you put it, like let's say if you invested 10 years ago into VOO, you would have almost doubled your money, doubled your money and a half, of course, something like this. Now, 5 years ago you would have doubled your money. 1 year ago, you pretty much 1/3 of your money would be just pure gains. So it is a fast, I mean, if we go max, I mean, there's not that much story for VOO. There's even more story for SPY, which is one of the oldest S&P 500 ETFs out there. It's I think it was one of the first ones. Started back in the 80s, I think. So this one has a little bit more story, but yeah, I know it started back in 1990, 93. So yeah, this is pretty much one of the oldest ones. So yeah, I mean, pretty much everybody that invested in the 90s is now sitting on a quadruple, not even quadruple, maybe quintuple their money. It's insane. It's insane, you know.
Yeah.
So
They
this
made
is
a
a
decent amount.
very yeah, yeah, yeah.
That's all
They
you need
pretty
to know.
much they'll do. Yeah, it's you know that's why you know like at this point being in the stock market it's less risky than not being in the stock market. Like the longer you are investing in stocks, the more your profit is gonna be. So just make sure you keep on putting money on a regular basis. Don't try to go all in. Just do a dollar cost average approach. Put enough passively into some safe ETFs and stocks, and you should be fine, no matter if it's a crash or not.
Yep.
But yeah, that's pretty much. Anything else, Eddie, you want to mention?
I think that's it. Does anybody have any questions?
So right now it's a good time to wait on investing for us.
Well, I mean, invest in ETFs right now.
Yeah, that's
Because
what I was.
it's safer. But if you want to buy, like, let's say,
I want to wait on the FTFs also because I haven't had time, but I'll do that probably by the end of the month.
yeah, I know, and also you know keeping track of the news because just like how the headline here, you know, it's Delta variant sinks stocks. Yeah, there's a chance if this gets worse. We're already back to like mandatory mandates of masks. So of course, if this gets worse, then we'll see, you know, more people get scared and sell off some of their stocks, and you know they need to buy actual consumer goods in order to, like you know, fight a new infection coming on. So yeah, just like watch out on the news, see what's going on with the Delta variant, see what's going on with what people are seeing about inflation. So it's not that it's not a good time to invest. It's just like keep an eye out for what's happening around you, because most likely what's happening around you is happening all over the state, and that's gonna affect the stock market.
I realized Bitcoin right now is like at $31,000. It went
Yeah,
down.
no,
It wasn't
it's
like
taking
around
a
36, around the 30s, higher than the 30s, and now it's like $31,000.
yeah, no, there's big fear. There's a lot. Actually, there's this thing. It's called the fear index of the stock market. There's like the stock market has a fear index. There's a fear index for crypto as well. You know, fear index. Yeah, you put maybe crypto, and then you do another one for fear index of stocks of the stock market fear index, and that way it's an easy kind of way of figuring out what people's emotional state is when it comes to the economy. So yeah, and everybody's in fear right now, pretty much at this point. Fear and greed index. Let's go with the same thing here. Fear and
Also,
greed index.
Ethereum just went down. I think it's a 1,800 and something.
Oh yeah, no, there's a lot of fear. Like with crypto, yeah, everything's extreme fear. Mostly everybody is on extreme fear. The same thing with the stock market. Yeah, we're pretty much extreme fear. So I mean, definitely, if you want to invest in some stocks, wait a little bit because the fear could get even worse, especially if the news get worse about the Delta variant and the inflation fears. And we know that at least at the moment, things are gonna keep getting more expensive. Now there is no end in sight, at least with the current trend that we're going. Actually, if I sell my car today, like a used car that I've had for 5 years, if I sell it today, I'll make more money on that car than I would have made 2 years ago when it was 2 years younger. It's crazy. It's just insane. Like I would make more money selling my car now than I would have selling it when it was just 2 years less of use. It doesn't make sense. But yeah, I mean, we are in extreme fear. We are in, and it's understandable. everybody's, you know, fearing what's going to happen with the new virus and fearing what's going to happen with inflation. So people, you know, are definitely fearful. But there's this one thing that Warren Buffett says, and it sticks through up to this day. Be greedy when everybody's fearful. Be fearful when everybody's greedy. So yeah, just take that with a grain of salt and make some good decisions in investing. So don't go all out and put all your money in, but you know, make smart decisions. Anything else, Eddie?
Yeah, I think this is a good indicator for myself, right? I use it when it's below 20. That's when I want to look to buy, right? Anything on the, okay, now this is what I'm trying to buy everything because everybody is selling, right? That's the time when you want to be buying companies that you like, or even the S&P 500, right? And I think it's better to be in the market than not, because you never know when it's going to pop off. Right? I think like right now it goes down, maybe buy one stock, right, or one share, and then if it keeps going down, maybe later on, oh, okay, I'll buy two now that it's less, and you could do that strategy, right? Because you honestly don't know when it's going to hit the bottom. So, more said, just keep an eye out.
Yeah. Yeah, if there's a stock you're tracking and you're waiting for a good buying opportunity, just like keep track of it. If you see that it goes another 10% down, then buy one stock. You know, it goes another 5% down, buy two. And you want to trickle buy as it goes low. You don't want to go all in. Like, and that's a strategy that I use, and of course most people use when it comes to investing. When I started buying Tesla, I bought one stock at 700. I saw that it came down to 650. I bought two. 600. I bought three. Then five something. I bought four. And then, you know, I kept doing this kind of like rollover, just buying this amount. You know, so it was like, okay, you know, I'll buy as it goes down. And at the moment I'm in a profit, I could sell now and, you know, get a good amount of profit out of it. But I want to wait because it's gonna go back up to 900 at least by the end of 2020, at the beginning of 2022. Once we have the Cybertruck, once we have, you know, the new version of the self-driving software, once we have, you know, their taxi cab system that they're trying to bring together once the self-driving is ready. So yeah, I mean, at this point, Tesla has a good road ahead. And at this point, like I hear, and this is one thing, you gotta make sure to hear what's going on around you. When I talk to someone, what kind of car they're trying to buy, they're not telling me I want to buy a Ford. They're not telling me I want to buy a Dodge. They're telling me I want to get a Tesla. So you also want to be like looking into what trends people are talking about. Like when they talk about phones, like they're not talking about, oh, I want to buy an Android phone. I want to buy an Apple phone. So that's when you know, okay, people are telling me that they want to buy Apple phones. Maybe I should buy an Apple stock because these people are sometime in the few coming months, they're gonna buy an Apple phone, and that in the end is gonna feed the value of my stocks. So, you know, as you can see, I mean, big tech is going up, and I think it's going up because people are scared of what can happen, so they're using it as a hedge against a crash, like an imminent crash. So it's not going up because it's actually good value. It's going up because people are scared that we're going to go into another crash. And the only companies that survived the crash back in 2021 and actually made money were big tech. So if something similar happens again, that's where people are putting their money. And they're hedging their bets against this big tech is going to do fine. Either if we go back to like living in quarantine, or we go back to, you know, like not going to work, or like big tech is going to do fine. So that can tell you where to put your money, at least have an idea where to put your money, whatever happens. Yeah, anything else in?
I think you hit everything.
Yeah, yeah, no, that's pretty much. I'll share this recording, of course, to the group, and I'll put it on YouTube. I'll send it to you, Eddie, so you can put it in your YouTube if you want as well.
Cool.
Yeah,
I'm
this
gonna
is
hit
pretty
the
much
stop. I'm gonna hit the stop right now.
it. Yes.